From Kroll, you're listening to ALTLOOK, the Alternative Investments Podcast, a series focused on key market, valuation, regulatory, compliance, and other nuances of alternative asset investing from various perspectives, including those of fund managers, general partners, investors, limited partners, regulators, and other interested parties. In our fifth episode, Kroll's managing directors David Larsen and Ross Hostetter discuss how the SEC's new fair value rule will impact registered investment companies and, by implication, registered investment advisors.
I'm David Larsen, a managing director in Kroll's, formerly Duff & Phelps, alternative asset advisory practice, and a member of the Kroll Institute. I'm joined today by Ross Hostetter, a managing director and a leader of Kroll's North America Portfolio Valuation practice. Ross and I have worked together as part of the alternative asset advisory practice for more than 15 years. Welcome, Ross. Appreciate you joining me today.
Thank you, David. Very glad to be here.
In today's episode, we'll focus on a new regulatory rule that has come out from the U.S. Securities and Exchange Commission, the U.S. SEC, which is named Rule 2A-5. And while it's applicable for those regulated by the SEC, we expect over time that it will become, many of its principles will impact a number of managers around the globe. Definitely those that are registered investment companies in the United States through the SEC. That's mutual funds, business development companies, and unit investment trusts. But also over time, I think that the new rule is going to impact registered investment advisors, meaning those managers or GPs of private funds, which is a much more pervasive group that will be impacted by the regulation. So Ross, I want to kind of talk, as we think about Rule 2A-5, maybe you can just kind of give some of the headlines as to why we have it, how it's applicable. We know it's applicable to 1940 Act funds, 40 Act being before you and I were born. But really, if we look back and when the last rule about fair value and valuing in good faith was issued, it was way back in 1969 and 1970. I think before you and I even really thought much about alternative assets, what they mean, that we would be deploying a good piece of our career in that space. Give us a little bit of an overview of where we are with 2A-5, what it starts to tell us about, and kind of an overview, and then we'll delve into it a little bit deeper.
Great. Thanks, David. Yeah, look, I would say that this is welcome guidance. I don't know that we always say that when new rules come out. You wonder how it's going to impact your business, your processes, risk, compliance, execution, all of those things. And this is an instance where I think people can take some relief, if you will, that this is helpful guidance to fund managers and to boards. As you pointed out, this applies to 40 Act funds, but I think it's very much applicable by extension to GPs, asset managers that are managing funds and discharging their obligations to report fair value on a timely basis. In essence, what the SEC has observed and acknowledged is that both the volume and complexity of the assets that boards are charged with fair valuing in the alternative space has grown in volume and complexity. And there needs to be some guidance and rules to help a board, again, in the case of a 40 Act, but a GP in the case of a traditional private equity fund, help them discharge their obligation to fair value these investments on a periodic basis. And so again, I think the guidance is helpful here, and maybe a little bit further into the details of it. I think what we've seen time and again over the years is new funds start out and there's a new valuation committee or an audit committee that's charged with reviewing the investments. And you start out with a new fund, you have 2 or 3 investments, and a board member or an audit committee member can go in and really delve into the detail of every investment, all the particulars, evaluation support, the minutia, and so forth associated with supporting a full fair value analysis. And that's great. And it works really well that first quarter. Fast forward in time, a year or 18 months, and now instead of 3 or 4 positions, you have 50 positions. And instead of 20 pages of documents to review, it's 500 pages, and it becomes overwhelming. And the question is, for someone in an oversight role, really, where does my responsibility begin and where does it end? And how do we decide to set those parameters? And really, David, as we get into the details of what's provided in the new rule, I think that's the essence of it. Where does my responsibility begin? Where does it end? How can I discharge these duties or obligations in a way that's consistent with my fiduciary obligation?
And I think that that's key. One of the things that didn't change is the board still has that obligation to provide or report fair value in good faith. And fair value in the context of the SEC and Rule 2A-5 is conceptually similar to the definition of fair value that we used in our episode 1, that being what would you receive in an orderly transaction using market participant assumptions as of the measurement date. But the SEC uses a little bit different words. So the concepts are the same, and we'll talk about fair value the same as it is in the accounting context. But I do want to at least highlight that the words the SEC uses are a little bit different. It works out to be exactly the same, but if you read 2A-5 and you say, hey, fair value in Rule 2A-5 seems to mean just looking at the actively traded securities or just looking at those that are not actively traded, well, the accounting standard kind of covers everything. That's true, but you get to the same answer. So, Ross, you worked with a lot of boards, in particular in the BDC or business development company space. How are boards reacting so far as they've starting to look at the rule? Are they still in that kind of phase of trying to understand it and see what it means to them? Or are they proactively looking forward to next year when it's implemented or fully effective? And are they thinking about doing things differently?
Yeah, David, I think it's maybe a mix, as you would imagine, across the continuum. I think most boards are aware of the new guidance and have a sort of a summary level perspective on what it actually means. I think people are in the process now of digging into the details to understand what needs to change around their current process and how will they go about implementing that. I think you made a very important point at the outset that this rule doesn't require, it's not a change in the fair value standard or definition, doesn't require you to value something today that you didn't value before. Really, in a nutshell, it's again about documentation of a process and some incremental testing involved to demonstrate that you're discharging your obligations. So I think at this point, most boards are digging into the detail to understand what incremental steps do we need to take to be in compliance. I'd say that's true on the BDC side where the rule is directly applicable to them. I think I would add another category there, again, that we alluded to at the outset is for the rest of the alternative asset manager space. So think of a traditional private equity fund or a credit fund or whatever the case may be. I think the industry is sort of grappling with, well, if I'm not a 40 Act filer, does this apply to me? And as you said at the outset, we think by extension, it does in a way. And in fact, I mean, not technically applicable. You're not a 40 Act filer. You're not technically under this guidance. But if you ask yourself, what would be the risk of me in an oversight role not discharging my obligation? Well, where would you look to see what a sort of best in class or best processes should look like? And I think that's where this Rule 2A-5 becomes by default, applicable to a traditional fund manager. So I think you have some of those questions going on now in discussions, trying to understand how does it apply to me? And then again, what further steps do I need to take to demonstrate that I'm in compliance?
I think that's helpful. Maybe just to put it in context a little bit, if we kind of look back over the past couple of decades and go back in time, again, a board for a 40 Act fund has always been responsible to estimate fair value in good faith, meaning coming up with an estimate in particular of those investments that are not actively traded. What would be the value that willing buyer, willing seller would transact? Where would they be in that overall context? Since that, again, that's been there. It's been there since 1969 to 1970 with the rules that we had at that point in time. But then a lot has happened in the last 15 to 20 years. We had the PCAOB established the Sarbanes-Oxley Act. We had the adoption of various compliance rules for investment companies. Some of those came in 2003. FASB issued their new fair value guidance in 2006. It didn't change anything as part of requiring fair value for investment companies, but it put the light on the issue and really kind of highlighted what does it mean when you're estimating fair value as the amount that you'd receive in that orderly transaction. And so over time, it became clear that with the number of investments that are out there, the different types, the complexity of investments, boards were a little bit in the dark to say, all right, do we have to do it ourselves, as you said, Ross, or can we delegate? And so this new rule identifies several things. One, it does define a readily available market quotation. It does that in the same way as FASB does. You need to have an active market. There needs to be sufficient volume and frequency to determine a price. And then if you're not looking at things with a readily available market quotation, then you look at things in the context of that's where you determine fair value in good faith. And that fair value is really those kind of said differently or said in the accounting context using level 2 and level 3 inputs. So if we kind of then say, all right, what are the board's responsibilities and kind of can they delegate? Ross, I think if I remember right, the rules got 4 primary responsibilities of the board. And then if they choose to delegate some of those, there's some additional responsibilities. Can you kind of give us a highlight on what those new articulated provisions are?
Yeah, so I think about it in a couple of steps. One is that, in the SEC's eyes, to have a full and complete valuation, you need to first sort of assess and manage the valuation risk. The second is establish and apply fair value methodologies. The third is to test those fair value methodologies. And the fourth is to evaluate pricing services. So those are 4 elements that have to be included. And if you choose to delegate, there are additional steps, and maybe we'll get into what those additional steps are. But if you're going down the path of delegating, but maybe just to hit these first ones, assess and manage the valuation risk, I think that really speaks to the heart of what the rule is about here. Again, the acknowledgement that in this space, both the volume and complexity of assets have increased materially over time. And so being able to understand where is the risk in the valuation of a particular investment. Is it the risk because it's a more volatile asset class, or is it risk because of the complexity of the valuation methodologies are being employed? So that one, I think, is relatively straightforward. The second rule here, establish and apply fair value methodologies. I think if you consider the broad 40 Act group, so a mutual fund, for example, the methodology there is traditionally liquid investments, P times Q, and then occasionally there's some illiquid investment. There's not a lot to talk about. When you get into the more illiquid space, particularly in the BDCs, which are almost predominantly illiquid, and then again, by extension to the alternative space, understanding what those valuation methodologies are is critical. And I think the more we see funds diversifying their portfolio of investments, recognizing that the valuation methodologies that might be applicable to valuing debt, for example, would be different for valuing equity or structured products or any of the number of asset classes that are out there. So understanding what those methodologies are on the surface is straightforward, but in application, it can be complex and sometimes overwhelming. And then quickly to touch on the last 2 here, the testing the fair value methodologies, I think this is an area where there's probably work to be done at a minimum in documenting this. But the idea that you set up a valuation process, you have methodologies in place, that's great. Does it work? And what do you do to sort of evidence that it's worked over time? And so testing that the fair valuation methodologies are working, back testing is an example of that, and then documenting that you've done that. And then the last piece, evaluating the pricing services. To the extent that you've used a third-party pricing service, what measures are you doing to evaluate that service or that provider? I would say both on entry, are they qualified to do the job at the outset, and what have you done to diligence that? And then on a go-forward basis, what do you do to sort of understand that they're still qualified to do the job, that have the scale or the capability to do what they've been asked to do? And then the other part of that is that portfolios evolve over time. Do they still have the credibility and skill to address the valuation needs of never-changing portfolios? So those are the 4 main things that have to be done for any valuation to be, quote unquote, considered complete in the SEC's eyes.
And I think that it's interesting that the rule allows the board to designate or delegate these activities to the investment advisor. As I look at it and say, all right, if I'm a board member, what kind of things do I want to think about and how do I do that? And I think about it also, some have asked us in the context of our practice, given that we touch and we see a very large number of managers and a very large number of investments, where do we kind of fit in that overall process or in these new rules? And I think that we kind of fit in a couple of different places depending on how you look at us. Testing fair value methodologies. Boards have that obligation. That doesn't mean they have to do it themselves, but they have to know that that testing is taking place. And so that testing role can kind of come in a couple of different ways. One, maybe they engage somebody who has expertise and experience to be the tester, to provide some level of assurance over the internal process that is used by the investment advisor. I think that we've seen that in a number of cases that happens. In other cases, a manager may, or the investment advisor may outsource the valuation process or the conclusion to a third party. Well, there still has to be testing. So in some ways, maybe you have to kind of look at the paradigm a little bit differently. And often I've had discussions with a number of the mutual funds that are kind of possibly going down this path where they say, all right, we already do certain things internally with our outside provider of our pricing agent or our valuation agent, where we do a model review, where we talk about process and so forth. That may, in some cases, be sufficient from a testing perspective. So I can see that third party, the use of a third party may fit in different places depending on exactly how a board looks at how they want to execute under this rule. And I think also when we talk about pricing services, the PCAOB also talks about pricing services, but they kind of use a different definition than is used by the SEC in this rule. The SEC is a little bit more broad. And so I look at that in the context of getting any third-party price, whether it's for a traded bond or whether it's for a level 3 security or a highly illiquid security where you're using very judgmental inputs, is that you really need to understand the expertise of that provider. You need to make sure that prices are, if you're reporting traded prices, that they're contemporaneous, that they're actionable for the size of position that you have, and that if they're using a quote-unquote model, that you have sufficient reliable inputs and validation of what's happening with that overall model. The rule kind of goes into a great deal of detail, Ross, about if you do delegate, and I would expect everybody to delegate or to designate the investment advisor. Now, let's say all boards. When I say everybody, I mean all boards to do some level, if not extensive, delegation or designation. Then when they do that, they bring upon themselves some new reporting requirements, more formal reporting requirements. They're fairly extensive, but maybe, Ross, you can just touch on those briefly, what you have to do, let's say periodically, and maybe more ad hoc.
Yeah, so I think on a quarterly basis, if you're delegating, then you need to summarize and document changes in your valuation risk, methodology, and designate process for overseeing a pricing service. So sort of the context, the way we think about the work that we do, the sort of notion of calibration, which is to say you sort of reconcile your valuation at T0 to the price that was paid. You have a process in place, methodologies and so forth to get you back to a starting point. And then on a go-forward basis, you're trying to understand what's changed over time. And I think the parallel here is exactly that. We have a process at the outset. We get comfort with the oversight, the procedures, the methodologies. We have an understanding of the risk in the portfolio, the methodologies that need to be employed to fair value those positions. We have a process with the third-party provider, and we've sort of checked all the boxes and we're comfortable. And so we have a nice starting point. But what happens over time? And so that first sort of check-in spot is on a quarterly basis to say, well, has anything changed around any of those sort of key elements? So you can think about valuation risk. Just as a simple example, maybe you started out in a relatively low volatility portfolio, and now you've moved into new asset class. So that would be a change. That would be a change in the risk. Methodologies, again, maybe you have a good methodology in place for the assets that you have, but conditions have changed for a position that maybe has deteriorated in credit quality or risk. And now you're changing valuation methodologies. And then certainly to the extent you're using a third party, if circumstances have dictated a change in that process, then that needs to be sort of highlighted on a quarterly basis. And again, I think that all makes sense. You start out with a process, you try to design as best as you can to be best in class. How do you monitor what's happening on a go-forward basis? And those are sort of the three key things that you look at, again, changing the risk, methodologies, and the process for overseeing a pricing service. There's some incremental steps on an annual basis, which is to have a written assessment of the adequacy and effectiveness of the designee's fair value process. So again, something that you probably have a discussion about in an audit committee meeting that maybe hasn't been documented in the past would be required now to be documented. A summary of your fair value testing, so back testing as an example, being a formal process, documenting that. And then this is an interesting one, sort of assessing the adequacy of the resources allocated to the process and any changes to roles and responsibilities. So again, think about the fund that starts out with 10 positions, 15 positions, and that's manageable. And fast forward a year, 18 months, and maybe now it's 40 or 50 positions, and the volume has gone up significantly. Do you still have the processes and resources in place to discharge that duty in an efficient way, in an accurate and effective way? And that's something that changes over time. So you need to assess that. And then the last piece, David, you touched on is kind of what happens on an ad hoc basis, which is, again, I think somewhat new here, is a requirement to report material errors in your NAV calc within 5 business days. So if you're the designee, you have an obligation to report to the board or the overseeing party any material errors in your NAV calculation on a timely basis. You also have to specify the roles and responsibilities, and there's some specific requirements about portfolio managers not being able to determine fair value, which I think in practice people have understood that all along, but that's now sort of part of the formal language. So I think maybe the takeaway here is there are specific steps that are in place. I think they all are intuitive and make sense. And my guess is that many of these discussions happen on a regular basis anyway. But I would say that boards and audit committees and GPs probably have some work to do to make certain that they're actually documenting these steps that are taking place. And I think that would be the big takeaway to me on those items.
I think as we're working with boards already, as they're trying to understand how do they implement this rule. Again, the rule is fully required, let's say September of 2022. There was about an 18-month implementation period after it was published in the Federal Register. So I think it's September of 2022 when it's fully effective. But I think boards are already, we're working with boards on how would that reporting look? What would it look like hypothetically if there was an exception? How if there was a change? So we're kind of working with boards through their formal board meetings, sometimes with board workshops, to gain a better understanding of how they can and should exercise their role in the context of this new rule. Maybe as we kind of wind things up, Ross, I think we've touched on a lot of the requirements. Things will evolve over time. But if you kind of fast forward to seeing a world, let's say 2023 and beyond, where there's now the SEC is looking to see, how has a board complied with the rule? Are there any things that kind of you could hypothesize on what would the SEC be looking for? What would that world look like when they're looking back to say, all right, did you comply with the rule? What are you doing?
Yeah, I think maybe I'd answer it this way, David. I think there are two things, both highlighted here, but one is understanding the valuation risk, just the inherent risk in valuing the assets that you have in your portfolio. And I keep coming back to the same point that as we've seen funds grow over time, funds that we started working with years ago that were traditional buyout funds or maybe single strategy funds, they evolve over time. They move into different asset classes. And understanding as a board member, an audit committee member, how has that risk changed? And are you addressing that risk in the procedures that you put in place? So that's the first point I would make. And the second point, and this is one that's tripped up boards in the past quite a bit, is understanding the valuation methodologies, and not from a technical textbook point of view, but understanding what methodologies are employed to value the assets that you're charged with overseeing, and what are the key value drivers? What is the risk inherent in the valuation approaches that are being applied, and understanding what they are. And again, I think historically, this sort of tripped up some boards in the mutual fund space that had lived predominantly in a P times Q or liquid trading atmosphere. That's easy enough from a valuation point of view to get a price in the liquid market, but they started to delve a bit into the illiquid space and were not able to demonstrate an understanding and acknowledgement of, one, how those assets were being valued, and point two, what was the risk in that, the risk in the inputs and assumptions. So I think that's the challenge for a board in an oversight role, is making certain they continue to maintain a handle on the portfolio, the risk in that portfolio as it evolves, and understanding the methodologies and the key drivers in those methodologies and the associated risk. And, the last point is just coming back to, I always hate to say it, but documentation. So again, a lot of these discussions happen in an audit committee setting or evaluation committee setting, but they probably aren't documented quite as well as they need to be. And so maybe it's that last point I would say may require the most work, is the documentation element, and where people may also get tripped up here if they don't comply.
I think that was well said, Ross. I think it's clear valuation is an ongoing priority. Valuation for hard to value assets or illiquid assets requires a great deal of judgment. Boards need to have a process in place whereby they can execute and comply with the provisions of the new rule. They can be done, but it does take probably a little bit of extra effort and some additional thinking or changing of a historic paradigm in some cases. So Ross, thank you very much. Appreciate your joining me today. And as always, we welcome questions and suggestions for our future episodes of this podcast series. Please reach out. You can reach out to me, david.larsen@kroll.com, or podcasts, podcasts @kroll.com. Thank you again, Ross. Thank you all for listening. Have a great day.
This has been episode 5 of Kroll's ALTLOOK, the Alternative Investments Podcast. Thanks for tuning in. And remember to subscribe on Apple, Spotify, or wherever you get your podcasts. On the next episode, we will discuss the SEC's focus on alternative investment managers, including 2022 proposed new rules and manager examination priorities.